Where should you invest your money today? There are so many choices. Shares, gold, property, or even Bitcoin. Each has its own risks and returns. So I'm going to walk you through exactly what you can expect and who each investment is really suitable for, from the lowest risk to the highest risk. I'm purposely not going to talk about ultra safe investments like bank deposits and government stock. I just want to talk about assets that I consider to be growth assets or growth investments. So let's start at the safest end, the investment people have trusted for thousands of years, and that's gold. Now, I consider it low risk. It's the type of investment that over the long term will keep pace with inflation. Literally over the last few thousand years, it's done that. So I would say typically, because inflation in the UK is around 4% at the moment, I'd say about 5% a year return you could expect over the long term if inflation's about that level. But funnily enough, gold in the last 12 months is up about 40%. So there are periods when it can really outperform upwards and underperform downwards. I've said it's got low volatility. In other words, the price fluctuates not too much. But to be fair, there are some years where it's fluctuated a lot, like the last 12 months where it's gone up 40%. But there certainly is a lot of demand for gold. Governments around the world are buying more and more gold as part of what's called their reserves. And because of that demand, it's felt that the price will probably keep rising for now, probably above the long-term average of inflation-linked type of rises. Now, the downside of gold, it's not like shares or a bank account or bonds that pay interest or dividends. There's no income from gold. It just sits there. It's not really very liquid. In other words, it can't be bought and sold very quickly as a physical asset, as a lump of gold, let's say. But where it can be traded quickly is if you have it in, say, an investment. It could be a gold fund, for example, although to be fair, most gold funds are invested in gold mining companies. But there are other instruments out there like so-called exchange-traded funds or ETFs that invest in gold. So indirectly, you can buy and sell gold much more quickly than a physical asset. Gold protects wealth rather than multiplies it. It's for those who want stability more than excitement, I would say. But what if you want both safety and growth, something that pays you an income as well? Well, that's where property comes in, or real estate. Now, there are two main types of property. Residential, typically your home, for example, residential property, and commercial, so business property, which can consist of aspects like industrial, it could be retail, it could be offices. Now, going back to residential property, these are houses and apartments where people live. That's always been a favourite in the UK. There's a saying about UK people. We say an Englishman's home is his castle. Well, England, not UK. Okay, I'd describe it as medium risk. Long term, you can expect a return of around 10% a year. Now, this is very variable in different parts of the country. And that is a combination of capital growth, the growth in value of your home or your investment property, and rental income. So about 10% a year is average for many, many, many years. Now, of course, there are differences, regional differences, and also it depends on how good an investment you've bought, what a bargain you've bought, for example. So you may make far more than 10% a year sometimes, you may make far less. But a general average for the average person, about 10% a year, which is pretty good. And it's very low in volatility. In other words, the price doesn't fluctuate up and down too much. In fact, it's rare that the value of your property falls in value, but I've lived through periods when prices have fallen. For example, I bought a property way back in 1987 and I paid £74,000. A year later, it was worth £140,000 by 1988. And a year afterwards, it dropped from 140,000 to 90,000. So there can be periods when property prices can be quite volatile, but that was in a very high inflation, high interest rate era, very different to today. So, and there was many years afterwards where lots of property owners who bought at the peak in 1988, who ended up in what was called negative equity. In other words, they owed more on the mortgage than the house was worth. And that went on for quite a few years, I remember. So it's not a given, but most of the time I've come across steady growth in value of properties, and there's a lot of demand for property to rent because we've had a lot of immigration in recent years. People are living longer. More people are living in smaller families. For example, more people are divorcing, splitting up, or not marrying for a long time. So there's a lot more small households, like one person or two people. So there's a lot of demand for property to rent. So it's very good in that respect for landlords to find tenants. But of course, that's not the only aspect. So apart from the capital growth, of course, it provides rental income. I would say it's illiquid, meaning you can't buy and sell it instantly. It's very difficult to sell a property in a short space of time. In my recent experience, I'm finding the time to buy a property has gone up quite markedly. In the past, if there's nothing to hold up the chain of buyers and sellers concerning your property, you could probably buy in within 3 months. I'm finding these days it's taken about 6 months. So it's definitely taking a lot longer. So it's not liquid. You can't instantly buy and sell it like publicly quoted shares. I would say this sort of investment, real estate, suits patient investors who want steady growth and income at the same time. And the other beauty of property, of course, is that you can borrow. You can have what's called gearing. You can take out a mortgage to buy the property, and you still get tax relief on the interest, although you only get it at 20%, which is the basic rate in the UK. It'll be different in other countries, of course. So that's a great way of buying. It helps you. You don't have to put down as big a deposit, whereas if you buy shares, you can't usually borrow to buy shares, for example. And so if property gives you steady returns, what about offices, shops or warehouses? That takes us into commercial property. Now, commercial property works a lot like residential, but with business tenants instead of families or individuals. I would describe it as medium risk, probably make about 10% a year like residential property. You get quite high rental yields normally on commercial property. It can be higher, can be lower. That's a combination of capital growth and rental income. Probably at the moment more if it would come from rental income than capital growth. I'd say the price is low in volatility. Recent years, values have come down because commercial property is valued completely different to residential property. Residential property is literally based on supply and demand. Commercial property, it depends on the rent level. Because the property is simplistically valued at a multiple of the value of the rent. So let's say the multiple was 10 times or 15 times the rent level. So if the rents come down, the value comes down. And interestingly, in the UK at the moment, typically the same square footage of property that's commercial is worth maybe 50% of the residential equivalent. So it's a great opportunity at the moment to get what's called permitted development from the council, which is like a sped up planning permission that only takes 8 weeks to convert from commercial to residential, typically into apartments, so offices to apartments. Because the demand for offices has come right down, of course, in recent years, more people working from home. So the commercial properties do give you long-term income because you typically have a lease, and the lease is a tenancy agreement that typically may last, say, 5 years. It's very good from the landlord's point of view, but not so much from the tenant, because the landlord's responsible for all the repairs and all the maintenance, has to return the property in the same condition they first rented it. So it's quite good for the landlord, not so much for the tenant. But of course, the demand for offices has come right down. So offices aren't as good an investment, I would say, as they were in the past. You've got to choose carefully the sectors you're going to invest in for commercial property. Personally, I would focus on data centres, energy centres, warehousing, because the demand for warehousing is increasing with a lot more internet sales going on. Maybe serviced offices, but normal offices, not a lot of demand now. Maybe the demand might increase more in big cities like London, but the rest of the country, I feel quite pessimistic about offices. But very good offices to residential conversions is a great opportunity. Of course, commercial property like residential property is illiquid. You can't buy and sell it instantly unless you have it in a fund, of course. So that's another disadvantage. There's a lot of regulations and laws to encounter, and you've got to be very patient, especially if you're doing development work. Now, property, as I've mentioned, is illiquid, so it's physical and it's slow moving. But if you want something faster, something more liquid, in other words, can be bought and sold instantly and easier to buy and sell, that's where shares come in. So first of all, I'm going to talk about publicly quoted shares. That means shares that you can buy and sell on a stock exchange. Think Amazon, Microsoft, Alphabet, the owners of Google, Nvidia, those kind of companies that you can buy and sell instantly. Now, shares are literally tiny pieces of ownership in big companies. Basically, when you think about it, it's fractional ownership. You may own some shares in, say, Apple, and you may have invested £1,000. You will own a tiny portion of Apple, very tiny portion, but you are literally an owner, a part owner of Apple. That's how these shares work. I would say medium risk, but that assumes you're investing in what are called large caps, so the larger companies, larger, more well-established companies. If you're investing in small caps, the very small companies, I'd say that's higher risk. But on average, if you've got a spread of shares, say in your pension scheme or in a fund, on average, if you hold them long term, in other words, 10 years or more, I'd say it's about medium risk. Historically, if you go back 100 years, 200 years, roughly about 10% a year return. Sounds very similar to property. I think this would outperform property long term. And that's made up of a combination of dividends, which is the income you get from shares, and the capital growth. Shares are quite volatile. Prices do move daily, and even the big companies, the difference in share price can be quite significant in a year. And I think it's an average of 60%, so it's quite volatile. 60% being the highest to lowest price in the typical year. So they do provide dividend income, as I've just mentioned. That's quite nice. And unlike the share price, dividends virtually every year rise, so they increase. As companies' profits increase, their dividends increase. And there are some companies that have increased their dividend every year for the last 10, 20, 30, 40, 50 years or more. It's quite incredible, these companies. They're well established. They're companies that provide things that people want and need, and they just keep growing and growing. You can find them just with an internet search. And that's quite a nice way of living your life. If you could build up enough money in shares, even though the price of shares will fluctuate, if you're just relying on the income, you're pretty much certain that your income will rise as long as you've got a good spread of shares. Let's say you owned, I don't know, 20, 30, 50 shares. I'd be very surprised if your income didn't rise every year. And that's like having a pension, really. So that's quite nice. In the UK, you're probably looking at a dividend yield, in other words, an income from, say, the top 100 companies of about 4% a year. That's pretty good, I think, especially if it's rising most years. Now, shares, as I've mentioned earlier, are highly liquid. You can buy and sell them instantly if they're a large company. If they're one of the small companies, they're called small caps, as I mentioned earlier, not always easy to buy and sell. There might not be a big market in the shares. You might have to be patient to sell them. So just be aware of that. So publicly quoted shares that you can buy and sell on a stock exchange, they're great for long-term growth if you can ride the ups and downs. You've got to have the right psychological mindset for this, because share prices are volatile, as I said. I would set aside 10 years to invest in shares. Don't expect an overnight success. And if you can't stomach big falls sometimes of maybe 30% or more, then shares aren't for you. You have to accept in return for the volatility in the short term, you're going to make a lot of money in the long term. If you stick to it and you have a good choice of shares and you do your research wisely. Now, where should you do your research? Well, there's many sources. There's many great books out there. I was just going to mention one in particular I've read recently, and that's called The Joy of Compounding by Gautam Bade. It's very good. If you're looking for some insights or some help in your research, then I run a separate podcast with a couple of colleagues of mine called the Intelligent Wealth Podcast, and we feature a different company each week. Most of them are well known, but not all. And I'm not saying this isn't a tips podcast, but it is one that helps you do your research. And we do prepare and offer one-page company snapshots, which I think you'll find very useful to help you in your own research. And I always say, don't follow anyone else's tips, because it's got to be something that suits your personality, your timescale, your needs and wants, your attitude to investment risk. It's got to be you. You can't just take a tip from someone else because that suits their personal circumstances. We're all different, and you've got to do your own research. The key is the research. If you do very good research, and if you just simply use common sense and you're patient, don't panic when prices rise and fall, buy when the prices fall. That's the best time to do it, rather than panic and sell. Then you're almost certainly going to do very well long term. Some of the greatest investors in the world, like Warren Buffett, are the richest people in the world. They've just had that great patience and used common sense and done a lot of research, spent a lot of time reading and not taking too much action. That's the way to do it. So what if you want even higher returns and you're prepared to tie your money up for years? That's where private equity comes in. Now, what I mean by private equity is companies that are not quoted on a stock exchange. You can't buy and sell them on a stock exchange. It could be a company you run yourself. Literally, that's private equity. But there are companies that are doing quite well. There are some very, very large private companies. And in fact, there's a huge percentage of companies now are remaining private for longer than going public, getting quoted on a stock exchange for whatever reason. So private equity means buying into companies before they hit the stock market. These are often startups or what we call early stage or high growth companies. There's a technical term they use. They call them unicorn, these small companies. I would say these investments, they're high risk, but potentially high returns. So I would say you're probably looking at 15% a year on average, but do expect some of your private equity investments to completely fail. You may have one or two that go through the roof and you make a lot of money on, but you'll equally have some that will fail completely. So you've really got to be accepting of that. You'll make far more money on the ones that succeed if you do your research well than on the few where you'll lose money. So the price can be quite volatile. I was looking at a company just yesterday. It's called Rigetti. This is not a recommendation, by the way. And someone I know had invested in those shares just very recently, had made 78%. Now, warning here, it could drop 78% just as quickly as it went up. So just be aware of that. The company, it could become very liquid. Your money might be locked in for years. So if you want your money out, say within 3 years, you may have to wait 5 years, 7 years, 10 years. But it could be worth it if you do your research, you're very thorough, you're very selective, you use common sense. There could be potentially very high return for the very patient. So this is more for very experienced, high-risk investors willing to accept failures in return for big wins. Now, if that all sounds bold, what about the boldest investment of all? The one that can literally double overnight. That brings us on to Bitcoin, the digital currency that isn't controlled by any bank or government, is the wild card. I describe it as very high risk, potential returns of 50 to 100% a year. That's not uncommon in the last 16 years. It's extremely volatile. It really does zig and zag up and down a lot. I consider Bitcoin the digital equivalent of gold. Like gold, it's got no income. But it is liquid. In other words, you can buy and sell it very, very rapidly on the internet. But it's not for the faint-hearted. In my opinion, it should only ever be a small slice of your portfolio, never the whole pie. Personally, I wouldn't invest more than 5% into it, maybe 10%. Just be aware that you could make a fortune out of Bitcoin. It has risen on average 139% a year in the last 16 years of its existence. That is phenomenal. And even over the last 5 years, it's still risen something like 800 to 900%. Again, this isn't a prediction of the future. This is the past. It doesn't mean it will always be like this. But I personally do like Bitcoin, and so I personally will invest in a small amount into it. So there you have it. 6 types of investments to invest in. The key is not chasing the biggest return, but matching your money to your goals, your time horizon, and your risk appetite. That's how wealth is built, with strategy, patience, and the right balance. At my stage of life, my goal is simple. I want to help as many people as I can to build real, lasting wealth. So if you found this video useful, please follow me and share it with anyone you know who might benefit too. Thanks for watching and have a great day.